This could be the comeback of the pound. That sun right in my eyes. I'm gonna have to do an Andrew Tate and wear sunglasses inside. So the Bank of England is quite hawkish at the moment. They recently cut their interest rates by 25 basis points. Now we can see here by using markets, the Bank of England cuts rates by 25 basis points to 4.0, with hawkish undertones amid upwards inflation revisions, cautious easing expected ahead of autumn budget risks. Now if we look here at the United Kingdom's economic landscape, we can see inflation has been ticking to the upside. So it peaked down here at 1.7 back in October of 2024. Since that point, it has just been rising. So you can see here it's gone from 1.7 to 2.5, 2.8, then it came up to 3.5, and it's currently sitting at 3.6, while interest rates have been decreasing. So what do we know? Well, when inflation is going up, we can't really have interest rates coming down unless there are other factors at play, such as the labor market and whatever else there is. So just looking at the inflation trend and the interest rates trend is not making much sense. So let's have a little bit more of a look. One of the big problems and something that has been driving these interest rate cuts is the unemployment rate. So we can see here, unemployment was at 4.0, kind of at its best back in October of 2024. However, if we're looking now, it's ticked to 4.7. However, it's been sort of around this range for a little while. It's not being a massive spike out of nowhere. It's been a gradual increase. So we can see 4.4, then 4.5, then 4.6, 4.7, which is where we are now. 4.7 was the same in July. Retail sales has come back up from being negative 1.3. It's now positive 1.7. That shows consumer confidence. People are spending more money. And then if we actually look at the consumer confidence index, it's not great. So it is negative 19. So it's definitely not a strong number. However, it has been an increase from the negative 23, and especially an increase from the negative 30 that we saw back in October of 2023. GDP has been climbing on a steady uptrend, if you will. We can see here it went from negative 0.2 to 0.9. It's now currently sitting at 1.3. Did come down a little bit from 1.5. However, it's still a positive to show that the GDP is gradually increasing over time. So if we look here at the UK heat map on the Edge Finder, we can see the same data reflected. So although it's not great, we are seeing some slight positives come in. Now keep in mind, previously, last week and the past 2 weeks, the UK and the pound have been heavily sold. The data was very, very bad. So we are seeing some of those factors start to pick up now. So we can see employment changes bullish. We've got PPI year on year and CPI year on year bullish because we did have those ticks to the upside as we already saw on market. Services PMI is also bullish. However, as we've already looked at, GDP did tick down, so that is a tick in that negative box. Manufacturing is below 50, that's really bad at 48. So when we're, a general rule for the PMIs, so services and manufacturing, 50 is sort of the baseline. If we're above 50 and climbing above 50, that shows expansion. If we are at 50 or below 50 and continuing to creep below that number, that shows contraction. No one wants to see an economy contracting. We want to see expansion. So that's why services is positive, whereas manufacturing is negative. Retail sales also, it is a tick in the negative box. However, what we did see was the previous was at negative 2.7. We saw the forecast at 1.2. We came out at 0.9. So the reason this is negative is because the actual release was less than the forecast. However, the way I'm looking at this at the moment is the actual was still above the previous, showing some better numbers. Although it wasn't what investors wanted to see, it was still good. So now we have an idea in our mind that we might want to go ahead and buy the pound. What could we trade the pound against? Well, we have to look at it objectively. What is trading? Well, we're buying the strongest, selling the weakest. That's as simple as it gets. So what's the weakest currency? Well, the weakest currency within my arsenal, I trade G7, G10 currencies. So within my basket of assets, the Australian dollar is the weakest at the moment. So I'd be looking to go long on pound Australian. So we can see here, interest rates are coming down, CPI is coming down, unemployment has been relatively stable, hanging around 4.1, 4.3. But what gets interesting is the retail sales are taking a hit. Yes, we did see a slight up movement in the previous release. Overall, really not great though. GDP also on a bit of a landslide here. Again, we did see a tick up from 0.8 to 1.3, but we didn't see an increase beyond that. Now, if we look here at the central banks, again, using markets AI, we can see RBA cuts cash rate to 3.6, signals gradual easing amid inflation near targets and rising unemployment. focus on data-driven future moves and September GDP release. So what does that tell us? Well, that automatically tells us right here that we need to be paying attention to the GDP of Australia. We also need to pay attention to unemployment and inflation. They're the three things that central bank is focused on right now. So inflation is near the target. We are seeing higher unemployment and we're seeing the GDP starting to come down, or at least stagnate. So as long as we can see GDP come out weaker, we could see higher unemployment, lower inflation, then we're pretty much set with this trade. And again, we can see the same things here on the Edge Finder. We can see the Australian dollars getting a score of 37. Now, I'm not going to run through all these things again, but you get the idea. So now we can go over to the Edge Finder. We can essentially just compare these two currencies or the two economies and see which one is stronger, which one's weaker. Well, we've already established which one's stronger and weaker. So now we just use this confirmation here. So we've got our retail, our majority short. So general rule of retail is we trade against them. So if they are majority short, which they are in this case by 76%, then we want to be going long. So that's a great factor in our trade idea. COT is relatively flat, so that's not telling us too much. Seasonality is bullish. The trend is bullish, as we can see here. We've got inflation that's on our side for the pound. We've got unemployment rate and interest rates that are all on our side. So with this in mind, let's have a look at the charts. Okay, so here we are on the daily time frame of the Australian dollar. And what can we see? Well, it's very, very simple. We've got a very, very typical sort of accumulation phase or range, whatever you want to call it. There's all sorts of fancy terms these days. I just call it a range. So there's a couple of things here to note. What we have is a very clear uptrend overall, and then some stagnation in price action. And this was due to a very weak pound at the time. And obviously we've had a weak Australian dollar as well. So two weak currencies didn't really drive much movement. However, now we've got some baseline to go long on the pound. We've already rejected our 200 moving average, indicating that buyers are still in control over the long term. However, we are remaining in this range bound market. So what I need to see is this RSI start to come down. We are currently in an overbought situation and we are still in this uptrend. So I would love to see price continue higher, have some sort of pullback, some sort of reversion, then start breaking out of this range, keeping it very, very simple. So I would attempt to go long on the bottom of this trend, somewhere around here, you know, it very, very price action dependent at the time. Stop loss below the 200 moving average. That gives us two levels of support. So then we'd have the very typical price action support. We would then also have the dynamic support from the 200 moving average. In this case, you have two options for a take profit. We could have a TP up here at this high at 2.13, or you could just deploy a trailing stop. So the way that would work is as price comes up, we trail our stops underneath the higher lows in this situation and then just let price run. And then there's two ways to get out of the market in that case. You either let price hit your trailing stop, or you pay attention to the macro data releases, and as soon as that bias flips to bearish, then we would exit the trade manually. So this is a very quick video explaining the pound Australian dollar and why I'm looking to be a buyer of this market. I realize I haven't been very active on this channel, so I do apologize. Life's just been very busy. As you can see, I'm in a new environment. So guys, I'll see you all later. Thank you for watching. Drop a like and subscribe. You can get access to market in the description. You can also join my Discord and follow the trades that I take in real time.